The Japanese yen has just wiped out nearly all its hard-won gains from that massive intervention we witnessed less than a month ago. US dollar to Japanese yen is once again testing the 159 level, a clear challenge to the authorities' resolve. By the end of this video, you'll grasp why that staggering $63 billion defense fell short and what Governor Ueda's unexpected hawkish turn means for the upcoming June meeting. We're entering a critical zone, where the market is pushing the limits of currency intervention without any structural policy changes. Historically, currency interventions act more like temporary band-aids than permanent solutions. Just 30 days ago, Japan's Ministry of Finance made a record-breaking intervention to pull the yen back from the edge of 160. Yet, without a change in the interest rate differentials between the Fed and the BOJ, the gravitational pull of the carry trade has proven too powerful. The market is effectively challenging the BOJ's stance, reclaiming the 159 level as global investors chase higher yields elsewhere, leaving the yen vulnerable once more. The numbers are staggering. Market data reveals that the previous intervention involved a jaw-dropping $63 billion. Yet, despite this effort, US dollar to Japanese yen recently touched 159.3, marking its weakest level since late April. This price action highlights the dollar-yen squeeze. As rising oil prices exert additional pressure on the yen, Japan, a major energy importer, must sell yen to buy dollars for fuel. In response to this mounting pressure, Governor Ueda has notably shifted to a hawkish stance, prompting market participants to price in a significant likelihood of action at the upcoming policy meeting. On social media and trading desks, the sentiment echoes, "Here we go again." Popular accounts like Bar Chart have pointed out that the yen has given back almost all its gains in under a month. Analysts at Gold Telegraph and Endgame Macro stress that the market effectively beat the intervention, as no fundamental policy shift supported it. Traders are now keeping a close eye on the 159.3 level, which represents a danger zone where the Ministry of Finance may have to act again, despite the diminishing returns from their previous efforts. Professional analysts are honing in on the widening gap between currency defense and monetary policy. The consensus is clear: unilateral intervention is hitting its limits. Experts argue that the yen's weakness is not just a Japan issue, but a reflection of the broader dollar-yen squeeze. Without a hike from the BOJ or a clear signal of quantitative tightening, the carry trade, where investors borrow cheap yen to buy high-yield global assets, will keep exerting downward pressure on the currency. All eyes are now on the BOJ meeting scheduled for June 15th to 16th. For Japanese equities, the yen at 159 presents a double-edged sword. While it usually benefits exporters, the volatility and the risk of a sharp carry trade unwind are making investors jittery in the Nikkei 225. Imported inflation is becoming a pressing concern for sectors focused on domestic markets, as energy and raw material costs climb. If the BOJ decides to pivot in June, we could witness a significant sector rotation. Investors should be cautious about crowded carry trades, as any sudden reversal in the yen could trigger global spillovers and sharp corrections in Japanese stocks. The yen's struggles are a warning bell for global markets. A weak yen fuels the carry trade, which boosts liquidity across everything from US tech stocks to emerging market bonds. However, if the yen hits a breaking point and we see a massive unwind, the resulting volatility shock could be felt worldwide. With US dollar to Japanese yen hovering around 159, the pressure on the Fed's higher for longer narrative intensifies, as a yen collapse could force the BOJ into aggressive tightening measures that the global financial system isn't fully prepared to handle. What should individual investors do now? First, keep a watchful eye on the 159.3 level, as it serves as the primary threshold for fresh intervention risk. Second, pay close attention to Governor Ueda's comments. A 70% probability of a June hike signals a major shift in market expectations. Risk management is essential. Steer clear of over-leveraging in yen-denominated assets until we gain clarity on the BOJ's policy direction. The existing wide interest rate gap remains the main driver, so any cooling in U.S. economic data could offer more relief for the yen than any intervention by the Ministry of Finance. Our AI analysis presents 3 distinct scenarios for the yen as we approach mid-June. In our base case, US dollar to Japanese yen hovers between 158 and 160 while markets await the BOJ's decision. Intervention remains a threat but lacks lasting impact. The bullish scenario for the yen anticipates a surprise rate hike from the BOJ in June, potentially triggering a sharp unwind of the carry trade and bringing the yen back to the 150 to 155 range. Conversely, the bearish scenario envisions a dovish BOJ hold, which could push the yen decisively beyond 160, compelling the Ministry of Finance into even more desperate and costly intervention efforts. To summarize, intervention gains have evaporated, US dollar to Japanese yen is back at 159, and the BOJ faces a 70% market expectation for a June rate hike. The market has shown that money alone can't defend a currency without supportive policy. Will the BOJ finally take decisive action, or are we looking at another $60 billion spent in vain? Share your thoughts in the comments below, and don't forget to subscribe for more in-depth explorations of the Japanese economy. I'll see you in the next video.